Hi, I'm Roger Montgomery from Montgomery Investment Management, and with me today to discuss the Aura Core Income Fund is Brett Craig from Aura. I'm extremely excited about partnering with Aura to offer the Aura Core Income Fund. Why? Because it offers retail investors access to a space that have really been the preserve of high net worth and ultra high net worth investors. Over the last few years, banks have been pulling away from lending small amounts for short periods to small and medium enterprises. It's just too labour intensive and too capital intensive. And smaller lenders like Aura can do it better. The Aura Core Income Fund leverages off Brett's experience and expertise, generating returns of over 9% for the last 5 years. And what's particularly impressed me about those returns is that there were no monthly losses, investors didn't experience any negative months, and that 5-year period took into account the COVID lockdowns that occurred globally and disrupted not only businesses, but the entire world. The Aura Core Income Fund will offer investors a pool of loans with higher security and a slightly lower return, aiming to beat the RBA benchmark by roughly 3 or 3.5%. So stay with me as I talk to Brett about the Aura Core Income Fund. Brett, over the last 5 years, you've developed a terrific history and track record. Can you tell me about Aura Credit's track record?
So the Aura Credit team have been managing the Aura High Yield SME Fund for just over 5 years now. Since inception, we've maintained a stable NAV, so the unit price has remained at $1 in that strategy.
And what's a NAV?
It's a net asset value.
Terrific.
So that is the assets value within the trust. And we've also produced monthly income in every month since inception with no losses for investors.
Speak to investors about the volume of deals and the default experience over the last 5 years.
In our other strategy, the wholesale strategy, the Aura High Yield SME Fund, we've run through over $500 million worth of lending in the 5 years since inception. We have had defaults in the pool, but none that have impacted the investor's capital or interest. So that's been covered by the underlying lender. We have seen loss rates around that 2% mark, but we build in protection to cover against those losses. And to date, investors have not suffered any loss of interest or capital.
When a borrower defaults, and invariably over time there's going to be defaults, how are investors protected?
The way we structure our deals with the loan originators is that the loan originators will have their income and some capital at risk as a first loss piece. So if there is a default in that pool of loans that they're managing, the first person to lose money is actually the loan originator through their net interest margin, their income, or their capital. This keeps them really well aligned with our investors' capital, because if they write a clean pool of loans, it maximises their income and protects their capital as well.
What specific investor need does the Aura Core Income Fund aim to satisfy?
Roger, the fund was really structured with a view to target investors who are after monthly stable income for their portfolios.
We've just had the RBA raise rates. Some investors might be concerned that the fund could suffer in a rising interest rate environment. How does the fund navigate rising interest rates?
As an investment team, we look to manage interest rate risk either through the use of floating rate securities, so securities where the yield will actually increase with the cash rate, or shorter duration fixed rate assets, so we can actually reprice those as they mature.
So in other words, what you're saying is because the loans are short term, they're paid back perhaps at a lower interest rate, but the new loans will be written at a higher interest rate as interest rates rise.
That's correct.
Investors will want to know what types of loans are in this fund. Could you give me a specific example of a loan in this fund?
Agricultural loans. So you might have a farmer looking to restock their property with sheep or cattle. Obviously farming is very capital intensive, so they've got a lot of that capital tied up in the land. They need money to purchase livestock. We work with one lender in particular who provides capital to farmers to restock their properties. These are maximum 12-month loans. We really like them because, cattle, sheep, they fatten up over time. Our LVR drops, therefore reducing some of our risk there. And we have weekly liquidity at the weekly cattle sales.
How big are these loans? What security do you take and what's their duration?
The size of the loans, the maximum we can do is 5% of the fund's asset to any one loan exposure. Based on our previous experience, the loans tend to be relatively small. Our other fund has an average loan size around the $100,000 mark with a maximum around the $1 million mark. From a duration standpoint in that agricultural example, we're looking at a 12-month duration through there. And the security that we take on that particular example would be first ranking security over the livestock, a general security agreement over the farming operation, which will generally wrap up the actual farm, and directors' guarantees from the farmers.
Brett, thanks for your time today.
Thank you for your time, Roger.
Pleasure.